Evolv Technologies just reported their Q2 2026 numbers, and, well, the headline figures present an immediate contradiction.
Yeah, they really do.
Right. So they missed consensus EPS by 2 cents, reporting a 5-cent loss per share. But on the flip side, they actually beat top-line revenue estimates. They pulled in $43.75 million against the $41.80 million estimate.
Which is a pretty solid beat.
It is. And management immediately followed that up by raising full-year 2026 revenue guidance to a range of $180 million to $185 million.
So you'd expect the stock to just take off on that news?
Exactly. But the stock reaction was all over the place. It got a 2.9% bump in the regular session to $6.03, ticked up a bit to $6.06, ticked up a bit to $6.06 after hours, and then dropped right at the open the next day to $5.80.
That intraday reversal tells you the market is really struggling to price in the mechanics of this quarter.
Yeah.
Because you have a top-line beat and raised guidance, which, typically triggers a sustained rally. But the deeper you dig into how that $43.75 million was actually generated, the more you realize the foundation of this growth is incredibly complex.
Which is exactly why we are opening up the Q2 2026 numbers today for you. Because now that the headline figures are out, this deep dive is going to walk you through the underlying mechanics of Evolv's quarter.
Yeah, there is a lot to unpack here.
There really is. We're going to break down the segment performance, those severe margin discrepancies, management's long-term targets, and the notable structural risks that are keeping the bears deeply engaged.
Because a 34% year-over-year revenue jump looks fantastic on a press release.
Oh, absolutely.
But it might actually be an illusion masking a massive shift in how they do business.
Well, the best place to start dismantling that illusion is by looking at where the revenue actually originated.
Right, the customer base.
Okay.
Evolv added 70 new customers this quarter.
Wow, 70.
Yeah, which is a critical metric because it represents their best quarter for customer acquisition in 2 years.
That's significant.
It is. It translates directly to the underlying recurring foundation. So their annual recurring revenue, or ARR, grew 20% year over year, hitting $132.7 million.
And the remaining performance obligation, the RPO, also moved in the right direction.
Right.
It increased 4.5% sequentially to $312.6 million, which for anyone listening who tracks forward visibility, RPO is the metric to watch.
Yeah, because it represents contracted future revenue that just hasn't hit the income statement yet.
Exactly. But I really want to zero in on the subscription gross margins here, which improved to 64%.
That's a big jump.
It is, and the underlying drivers are entirely operational, not just pricing power. They actually reported a $1.3 million decrease in field service costs.
Oh, wow.
Yeah, and a significant reduction in the disposal of their Gen 1 systems.
We really need to contextualize what a drop in field service costs actually means for a hardware company.
Right, because they aren't just a software platform.
Exactly. I mean, Evolv doesn't just sell software access. They sell massive physical weapons detection gates.
Big pieces of metal.
Right. So when field service costs drop by over $1 million, it indicates their technology is stabilizing in the wild.
Like less maintenance.
Yeah, it means fewer technicians rolling out in trucks, fewer emergency on-site repairs, and, fewer replacement parts being shipped overnight.
That makes a lot of sense.
Add in the fact that they aren't writing off as much old, obsolete Gen 1 hardware, and you get a direct mechanical boost to that 64% subscription gross margin.
See, building ARR in the software world is like adding server capacity to the cloud. Right?
Sure, it's essentially invisible.
Invisible and instantaneous. But building ARR for Evolv is more like laying train tracks.
That's a great way to put it.
They literally have to manufacture thousands of pounds of smart metal, ship it across the country, and bolt it into stadium floors just to turn the revenue on.
The physical friction is just immense.
Exactly. And this brings me to a major pushback on the whole headline narrative.
Okay, let's hear it.
You call adding 70 customers strong momentum and a 34% top-line jump looks like a massive demand spike.
Right.
But if we look at the fulfillment mechanics, aren't they just, front-loading hardware sales to juice the top-line revenue? I mean, it feels like they are robbing future quarters to make today's numbers look incredible.
That is the pivotal dynamic of this entire earnings report.
I knew it.
Yeah, to understand why the market faded the stock the next morning, you have to look under the hood at Evolv's shifting business model.
Okay, break that down for us.
So the 34% revenue beat was heavily subsidized by a fundamental change in sales fulfillment.
New contract, right?
Exactly. Back in December 2025, their primary distribution agreement expired. When that ended, Evolv pivoted aggressively toward a direct fulfillment approach.
Using what they call the purchase subscription model.
Yes, exactly.
When they say purchase subscription, I mean, it almost sounds like an oxymoron.
It kind of does.
But mechanically, they are essentially splitting the physical metal from the digital brain. Under a traditional pure subscription model, a customer leases the hardware and the software together over a set period, let's say 4 years.
Smooth, steady revenue.
Yeah, Evolv would recognize that revenue smoothly, ratably, month after month. It creates very predictable income.
But under this new purchase subscription model, that whole dynamic flips.
How so?
The customer effectively buys the physical hardware up front on day one and then subscribes to the software and ongoing services separately.
Oh, I see.
Because the physical hardware changes hands immediately at the start of the contract, accounting rules dictate that Evolv gets to recognize that large chunk of hardware revenue up front in the current quarter.
Rather than spreading it out over 4 years.
Exactly.
There's the financial sugar rush for the top line.
That is exactly what it is.
Management even noted that they expect about 60% of all new unit deployments in 2026 to utilize this purchase subscription model.
Right, which is up from about 55% previously.
So, while adding 70 customers proves the demand is absolutely real, the timing of when the cash hits the income statement has been drastically pulled forward.
And the consequence of that sugar rush is that those highly favorable year-over-year revenue comparisons we just saw, they're temporary.
Right, the crash is coming.
Starting in Q3, Evolv is going to anniversary those July 2025 pricing and fulfillment changes.
Meaning the baseline for comparison is going to reset.
Yes. Once that happens, those massive percentage jumps in revenue growth that characterize the first half of the year, they're going to vanish.
And the growth rates will look significantly more grounded.
Exactly.
Well, the problem with a financial sugar rush is the inevitable crash.
Always.
When the accounting shift stops masking the underlying numbers, you're forced to look at the bottom line reality. And for Evolv, that reality is stark.
Very stark.
Adjusted EBITDA came in at a positive $4.4 million, representing a 10.1% margin.
Which on the surface looks like a company turning the corner.
Yeah, management was quick to point out that adjusted EBITDA for the first half of 2026 actually doubled compared to the first half of 2025.
But there is a massive catch.
A huge one. You cannot look at an adjusted EBITDA margin of 10.1% and call this a profitable enterprise when the GAAP net profit margin is sitting at negative 21.3%.
Right. The gap between those two numbers is the literal cost of their business model.
Because of the physical assets.
Exactly. Adjusted EBITDA strips out depreciation and stock-based compensation. But when your business requires manufacturing heavy physical security gates, depreciation is a very real, unavoidable expense.
It's the wear and tear on the capital assets required to generate revenue.
Right, and their overall adjusted gross margins sat completely flat at 51%.
And that flat gross margin is the tell.
It really is.
If the core economics of building and shipping the product aren't becoming drastically cheaper, the GAAP net income reveals they are still burning significant cash to fund this expansion.
They are absorbing massive upfront capital expenditures.
So if this accounting shift only masks the GAAP losses for a few quarters, it raises a really critical question about management's timeline to actually stop burning cash.
Well, management's answer to that timeline isn't focused on the next quarter.
Let me guess, long-term vision.
Very long term. It's focused on the next decade. They are laying out an incredibly ambitious operational roadmap, targeting over $500 million in annual revenue by 2031.
$500 million.
Yep. To achieve this, they are adopting a framework they call the Rule of 50.
Okay, so in the pure software sector, we usually hear about the Rule of 40, right?
Right.
Which dictates that your revenue growth rate plus your profit margin should equal 40 or higher.
Standard sauce benchmark.
Exactly. So a company growing at 30% with a 10% margin is considered a healthy SaaS business.
Yeah.
Evolv aiming for a Rule of 50 is an aggressive escalation, especially for a hardware-heavy operation.
Very aggressive. They are explicitly targeting 25% annual revenue growth alongside 25% adjusted EBITDA margins.
That is a massive target.
It is. Hitting 25% EBITDA margins while continually deploying heavy hardware requires near-perfect operational execution.
But the analysts are buying it, aren't they?
Some of them, yeah. Sell-side analysts are buying into the vision. Craig Hallam actually raised their 12-month price target on Evolv stock to $11.25.
Based on what?
Well, their analysts specifically cited the accelerating unit growth and the raised full-year guidance as proof of concept that the company is on track to scale.
But you don't scale from roughly $180 million to $500 million by selling the exact same weapons detector to the exact same stadiums year after year.
No, you definitely don't.
You have to build a comprehensive platform and execute a flawless land and expand strategy.
Right.
And we are actually seeing the early mechanics of that expansion with the Evolv Expedite product.
The new bag screener.
Yes, this is their dedicated bag screening system designed specifically to sit next to and complement the flagship Evolv Express People Screener.
Because the physical logistics of security lines demand this dual approach. The Express system is fantastic at clearing the people walking through the gates, but the bags still create a bottleneck that requires manual checking.
Someone unzipping the bag and looking inside?
Right, which slows everything down. The Expedite system automates the bag screening to match the pace of the people screening.
Which makes perfect sense for the product lineup.
And the metric that proves this strategy is working is the cross-selling attach rate.
What's the number there?
Management noted that approximately 70% of new Expedite customers are also purchasing the flagship Express system.
Wow. A 70% attach rate is a phenomenal indicator of platform stickiness.
It really is.
I mean, if you manage to land a customer for the bag screener, you have a near guaranteed path to upselling them the much larger, more expensive people screening system.
Exactly. And that ecosystem lock-in is exactly how you drive net revenue retention above 100%.
Which they successfully maintained again this quarter.
Yep.
But, none of this matters if they cannot physically manufacture the machines fast enough.
The classic hardware problem.
Right. You can't hit $500 million in revenue if your supply chain is choked.
And recognizing that physical bottleneck, management highlighted their new contract manufacturing partner, Plexus.
Outsourcing the build.
Exactly. Evolv realizes they shouldn't be tying up their own capital building factories and managing assembly lines.
Leave that to the experts.
Right. By outsourcing the physical build to Plexus, who is a specialized contract manufacturer, Evolv expects to significantly improve their production capacity and eventually lower the per unit cost.
Well, beyond the manufacturing capacity, they also need buyers with deep, reliable pockets.
True.
And we saw strong validation on that front with their ongoing traction in government contracts.
This is a huge deal.
Over the last year, Evolv has secured over $941,000 in award payments.
And this isn't just local municipal buildings either.
No, this includes contracts for detectors at entrances for the National Geospatial Intelligence Agency.
Which is incredible. Securing a contract with an intelligence agency is perhaps the strongest stamp of validation a security company can receive.
Because the vetting process is insane.
Exactly. Government contracts are notoriously difficult to win, requiring endless compliance and testing. But once you get your foot in the door, the revenue is incredibly sticky.
Very hard to rip out once it's in.
Right. So if they can streamline the hardware manufacturing through Plexus while simultaneously expanding their footprint in both corporate environments and federal intelligence sectors, well, the trajectory toward that $500 million mark becomes somewhat visible.
Okay, so we have laid out the bull case, the $500 million vision, and the government validation.
The sunny side of the report.
Exactly. But if you are an investor looking at a stock that faded from $6.06 after hours down to $5.80 the next morning, you know the market sees serious friction ahead.
Oh, absolutely.
Let's dig into the headwinds. The bear case is built almost entirely around structural margin pressures and severe execution risk, right?
Yes.
Starting with the very fulfillment model that gave them their Q2 revenue beat.
Right. That shift to the purchase subscription model is a double-edged sword.
How so?
While it provides a fantastic top-line sugar rush by pulling hardware revenue forward, it exerts intense downward pressure on their gross margins.
Because hardware margins are just fundamentally lower.
Exactly. Physical hardware simply carries a significantly lower margin than pure software and digital services.
Right.
So if 60% of your new unit deployments are heavily weighted toward upfront, lower margin hardware sales, your blended gross margin is going to suffer.
And then you have to factor in the massive capital costs associated with upgrading the existing customer base.
The Gen 1 to Gen 2 upgrades.
Right. Management stated that about 60% of their renewing customers are transitioning from the older Gen 1 systems to the new Gen 2 systems.
Which is painful from a cost perspective.
It is. This is where the difference between software and hardware becomes painfully clear.
Yeah.
If you're a SaaS company, upgrading a customer to version 2.0 requires, what, pushing an over-the-air update?
Yeah, the marginal cost is practically zero. But for Evolv, upgrading a customer requires dispatching teams of technicians to a stadium, unbolting thousands of pounds of old metal, physically hauling it away, managing the electronic waste, and then installing the new Gen 2 systems.
That sounds incredibly expensive.
It is. The company has to absorb the inventory management costs, the deployment logistics, and the potential write-offs of the old systems.
Wow.
It is an incredibly capital-intensive process that continuously drains the cash flow they're trying to build.
And this physical friction ties directly into the third major risk factor, the broader electronic supply chain.
Right, the chips.
Yeah, management openly acknowledged that they are still battling semiconductor constraints.
Which is a problem everyone is having.
But it's vital here. No matter how efficient Plexus is at assembling the final product, if Evolv cannot source the fundamental silicon chips required to run the AI software, unit deployment stalls.
Yep.
And if unit deployment stalls, that $132.7 million in annual recurring revenue stops compounding.
The market looks at these three interconnected risks.
The margin compression, the massive capex of upgrades, and the chip shortages.
Exactly. The market sees all that and realizes that the path to true GAAP profitability is just littered with physical roadblocks.
Well, if you're an investor sitting at home trying to weigh the 34% revenue growth against these deep structural risks, the most actionable piece of context comes from watching what the executives are doing with their own shares.
Oh, the insider activity.
Yes. Over the past 6 months, there have been 0 insider purchases of Evolv stock on the open market.
Not a single one.
Not a single executive has stepped up to buy shares. But there have been 8 distinct insider sales.
The disparity between 0 buys and 8 sales is a really powerful signal.
It really is.
The market pays very close attention to insider behavior, especially during transitional periods for a company.
And the specifics of those sales are even more telling. Michael Ellenbogen, the company's founder, sold over 495,000 shares in the past 6 months, cashing out an estimated $2.8 million.
Wow, $2.8 million.
Now, obviously, executives sell stock for a myriad of reasons, managing tax liabilities, personal portfolio diversification, buying real estate.
Sure.
But when you combine heavy, multi-million-dollar insider selling with absolutely 0 insider buying, retail investors are naturally going to wonder if the executives see the incoming headwinds more clearly than the market does.
Think about the timeline we just discussed. Management is fully aware that starting in Q3, they are going to anniversary the July 2025 pricing changes.
The sugar rush ends.
Right. They know the year-over-year revenue comparisons are going to normalize, and those optically beautiful percentage jumps will vanish.
Yeah.
If you are an insider looking at a stock price buoyed by a temporary accounting sugar rush, knowing that severe margin pressures from hardware upgrades are looming on the horizon.
That is a highly strategic moment to take chips off the table.
Exactly.
It provides critical context as to why the broader analyst consensus maintains a very cautious hold rating on the stock, despite Craig Hallam's bullish price target.
Analysts see a company that is structurally unprofitable on a GAAP basis.
Right, relying heavily on pulling revenue forward to mask the cash burn required to swap out thousands of heavy security gates.
It perfectly encapsulates the classic growth versus profitability tension.
It really does.
I mean, Evolv has unequivocally proven they can capture market share. Adding 70 customers in a single quarter in an under-penetrated industry proves the demand for AI-powered weapons detection is massive.
The demand is there.
But fulfilling that demand requires building, shipping, and maintaining heavy infrastructure. That physical reality creates a relentless drag on the bottom line that pure digital companies never have to navigate.
Which leaves you with a final provocative thought to evaluate as you watch Evolv moving forward. As the company scales its AI technology and relentlessly chases that $500 million rule of 50 target, can a business so fundamentally anchored to physical manufacturing, supply chain logistics, and brutal heavy metal generational upgrades ever truly command the premium valuation multiples of a pure software-as-a-service company?
That is the big question.
The digital brain of their AI is brilliant, but it's trapped inside a very expensive physical body. Pay close attention to how that tension resolves when the revenue comparisons normalize next quarter. If you want to stay ahead of these accounting mechanics and understand exactly what is driving the market, make sure to follow the show for daily, no-nonsense earnings coverage. See you next time.